Ladies and gentlemen, good day and welcome to Craftsman Automation Limited earnings conference call for Q4 and financial year ended 31st March 2021. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Srinivasan Ravi, Chairman and Managing Director. Thank you, and over to you, sir.
Thank you. Good afternoon, ladies and gentlemen. Welcome you all to the first earnings call. Since this is the first call, I would like to take a few minutes to introduce Craftsman as a company, because many of you may be new to the company. We at Craftsman are a well-diversified engineering company who commenced operations in 1986. We are a comprehensive solution provider. We are present across three segments of the business, mainly the auto powertrain, the auto aluminum, and the industrial engineering sector. The industrial engineering sector being the oldest in our portfolio. We have 12 strategically located manufacturing plants across the country, well integrated. We have long-standing customer relationships, and always it has been a habit that we outperform the industry because of our leverage which we are presenting across all three segments of the business. I will just run you through the brief highlights of the last year, the company performance. The first and most important, I think we have reduced the debt of 1,040 crore to 704 crore from March 20 to March 21. Out of the reduction of 336 crore, 140 crore has come from the IPO money proceeds. Almost 200 crore has been from internal accruals. And that during the pandemic year, we have had an internal accrual of 200 crore to reduce the debt. So debt stands at 704 crore vis-a-vis 1,040 a year back. EBITDA, we have logged the highest EBITDA number, that is 447 crore so far in the history of the company. This is in spite of the small maintenance capex and some capacity balance capex of 106 crore. We have managed this EBITDA and results are in spite of the historically very difficult commodity price increase, mainly in aluminium for us, which is up in Craftsman, and also in steel. And we have performed well even during this pandemic period and also the commodity storm which we had. The operating cash flow to EBITDA stands at 80% when compared to 77% a year back. We have completed the IPO. We have raised 150 crore and we got the shares listed on 25th March 2021. Thanks to you all, shareholders, stakeholders, who have given an overwhelming response in a difficult period. The standalone financials for FY 2021, the sales stands at 1,546 crore. PBT has grown by 114% to 148 crore. Turnover has grown by 4.2% and stands at 1,546. The PBT growth from 59 crore to 148 crore at 114% is better management of cost, better management of finance cost also, and all other expenses like the maintenance cost, the traveling cost, and the selling expenses. PAT has grown by 164% from 37 crore to 97 crore. EBITDA has grown by 10% from 404 crore to 447 crore, from 27% to 29%. We have registered the highest ever EBITDA in terms of both value and percentage of sales during the year FY 2021. Capex for the year was 106 crore, mainly as a maintenance capex and some technological upgradation and some capacity balancing and debottlenecking capex. Total long-term borrowing was reduced by 251 crore. Short-term borrowings were reduced by 85 crore. Overall reduction in debt during the year was 336 crore. Now the debt stands at 704, vis-a-vis 1,040. I will just put across the financial ratios, which may be interesting for the shareholders and also for the lending banks and institutions. The debt equity has improved from 1.42 to 0.72. Debt to EBITDA has improved from 2.57 to 1.57. EBITDA margin has improved from 27% to 29%. EBIT from 14% to 16%. PBT from 4% to 10%. PAT from 2% to 6%. ROCE from 13% to 16%. ROE from 5% to 11%. The current ratio has improved from 0.79 to 0.96. Earnings per share has improved from 18.21 to 48.02. Operating cash flow now stands at 356 crore, and the cash outflow to EBITDA is, operating cash flow is 80% of the EBITDA. Now we'll move on to the segment-wise results. The auto powertrain has grown by 14%. The top line has grown from 709 to 811. The auto aluminum has grown by 28% from 258 crore to 330 crore. The industrial engineering has degrown by 22% from 516 to 405 crore. However, storage solution division, which is going to be very important for the company in the future, has had a growth of 42% from 73 crores to 104 crores. The automotive powertrain EBIT has grown from 151 crore to 221 crore. This is because of the better operating leverage we had in at least in one quarter. The growth is 46%. The automotive aluminum EBIT has degrown from 9 crore to 3 crore, mainly due to the increase of raw material price increase and the price variation clause which we have with the customers, which is always on a trailing basis. The upcoming quarter is, the prices are calculated on the previous quarter's commodity prices. Unfortunately, this is 1 year where we had the aluminum price increase of almost 50%, starting from last year March till this year March, and this has been a steady growth, increase in prices quarter on quarter by 10% approximately. So we really couldn't get benefit out of this. The price increase could not be passed on to our customer very easily. So the trailing quarter has given this impact of the degrowth in the EBIT. In the industrial engineering segment, EBIT has degrown from 94 crore to 78 crore, but this is mostly because of the top line and reduction a little. Plus, in industrial engineering segment, we have long-standing customers mainly, and we don't change prices very soon. So we just watched for the 2-3 quarters. Now we are negotiating with our customer, and all these price increases will come into effect in the coming financial year. The standalone financials for Q4 year-on-year, turnover was highest at 535 crore. We have demonstrated that at 535 crore, still we are not fully utilized on the capacities, but I think the operating leverages have kicked in at 535 crore for Q4, and EBITDA stood at 153 crore for Q4, which has been highest so far. The standalone financials for Q3 versus Q4, the automotive powertrain segment turnover has grown by 8% and EBIT by 22%. The automotive aluminum segment turnover has grown by 3%, but EBIT has degrown by 3 crores. The industrial engineering segment turnover has grown by 25% and EBIT has degrown by 2 crores. With this, I will leave the floor open for any question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nishit Jalan from Axis Capital. Please go ahead.
And congratulations on good set of numbers. So my first question is on the revenue performance. Like you highlighted that in the tough year, especially your powertrain segment, we have seen a revenue growth despite a weakness in the CV industry. So just wanted to get your thoughts, which customers or which new order wins have driven the revenue outperformance for us in this year, and how should we look at it in the coming 2 years as well?
In the auto powertrain, you may recall that the FY20 has not been a great year at all. We're coming from a lower base. FY19 we performed better. This is because of the big implementation across mainly the commercial vehicle sector and the passenger vehicle sector where we are present, and not so much not on the tractor segment and the construction machinery, but still I think the inventories had to be cleared out there. So there was a big slowdown in that particular year. On a lower base, still the base has been, this year has been, the last year has been still lower. In spite of that, we have grown for the simple reason, value add per vehicle, value add for the higher end products what we are manufacturing after the BS6 implementation. The product mix has changed for us. This has helped us for the revenue growth. Going forward, we all know that FY19 was a good year, FY20 was bad, FY21 was even more bad. So from this base, we expect only to grow. Post this pandemic, we do not know how this pandemic is going to pan out in this year. So once the pandemic is totally over, this from a lower base, surely will be set to grow.
Okay. Sir, any specific customers you would want to highlight where you are doing better? And secondly, you talked about higher content per vehicle. Can you give some numbers as to how has the content per vehicle changed between BS4 and BS6?
First of all, I would not like to, because we supply almost to 2 of the 3 leading players in the commercial vehicle sector, medium and heavy duty. And for the farm sector, almost everybody, except 1 or 2, we are supplying. So I will not like to use customer names, but very well we have seen the migration of medium duty trucks to heavy duty. So the bulk of the sales has been heavy duty. So this means it requires higher gearbox capabilities and capacities. Plus the number of axles per truck is higher. The duty load per axle is more. So the vehicle content is more. Even the engine, I think when you move to BS6, there are more stricter tolerances. In certain cases, when we are doing the finishing of the cylinder block, I think it calls for more critical operations and honing, and the prices are different. So this has led to better value add for us in the powertrain business.
Okay, sir. Thank you. Sir, my second question is on the lines on the capex side. Like you highlighted that we have still not reached full capacity utilization. So in that context, how should we look at capex in the next 1 to 2 years, and what does it mean for our cash flow generation and debt reduction plan?
You would have noticed that in the last 2 financial years, we have been averaging of capex around 100 crore. We'll be around that region because you know that our gross block, the real gross block, that means after Ind AS, the net block became the gross block. So whatever you see on our balance sheet will be slightly different, but we have a gross block of more than 2,500 crore. So the maintenance capex will be around 2 to 3% will be there. Apart from that, there will be some small pockets and segments what will be there. So we'll be managing this capex around this region going forward. And I'm confident that the debt reduction has happened of 200 crore from internal resources in the last financial year. Even as the pandemic is still continuing, we are still focusing and we are targeting a debt reduction of 200 crore in the coming year also.
Okay, sir. That's very good to hear. Thank you so much. I'll come back in the queue.
Thank you. The next question is from the line of Abhishek Jain from Dolat Capital. Please go ahead.
First of all, congrats for a strong set of performance. Sir, how was the segment-wise revenue mix for the powertrain business in FY21? As we know that around 50% revenue comes from the MSCV segment, and MSCV production was down 22% in FY21. Despite that, your powertrain business grew by 14%. As you are saying that there is an increase in content per vehicle in the MSCV. So just wanted to understand how is the generally content per vehicle and how much increase in FY21? And the second question is the segment-wise revenue mix.
Please repeat the second question.
So how is the segment-wise revenue mix for powertrain business?
Okay. More or less, it has been the same. The segment-wise the mix between commercial vehicle, the farm equipment, the construction machinery, and the passenger vehicles. You know that on the passenger vehicles, we are exposed very less and mainly to the little more heavy-duty engines, which are for the SUVs. We are not on the lower end of the passenger vehicles. So your question about how we have grown is because the engines have become more powerful now. For the average truck, I think it is more than 37 tons now. From an earlier 4 years back, it was on 16 tons. Then it moved to 25 tons. Now it is 37 tons. And the biggest seller is even the real heavy-duty segment, which is 49-ton trucks. Main reason is they are more fuel efficient. They are more powerful. The cost of the cost of ownership or the cost of operations are much lesser because of the driver cost. They cover more kilometers per day. And the cost per ton for transport is far better. So I think the fleet owners are modernizing their trucks post GST because the hurdles of check posts have been removed. The highways are better, and the customer also expects the goods to be delivered faster. So with all that, I think these trucks have become far bigger. So with that, the gearboxes have become bigger, the engines have become bigger, plus the number of axles per truck has increased.
So can you give some numbers regarding the segment-wise revenue mix? Because in the last con call, at the time of IPO, you had told that around 50% revenue comes from this MSCVs, 10% from the passenger vehicle, and rest is from construction and tractor business. So in FY21, how is that?
Yes. For the powertrain business from FY20, the commercial vehicle has grown by around 54%.
Mix between the mix of the total.
Oh, mix. You ordered the mix. The commercial vehicle mix is 54%, off-highway is 19%, tractor is 19%, and passenger vehicles is 7%.
And in commercial vehicle, how is the mix for the LCVs versus MSCVs?
I think 90% is heavy duty.
Okay, heavy duty. Sir, my next question is related with the margin of powertrain business that has seen a sharp jump around 600 bps Y-on-Y. Can you give color on the key factors which drive the margin performance apart from this uplift?
Fundamentally, the operating leverage in most of the powertrain business, we are not buying the raw material also. And if there's a material, there's a straight pass-through. That is, there's no time of lead or lag between the raw material purchasing price to passing on to the customer. So we are not affected by the commodity, number one. Number two is the operating leverage. The fixed cost about people and plant costs have been better distributed with the higher revenue.
So how is the outlook ahead?
We had only 1 quarter of a good revenue, really speaking, that is Q4.
Okay. So just how is the outlook ahead given the sharp increase in the commodity inflation? So what is your outlook for the FY22? We know that the first quarter will be quite big. So might be that there will be sharp fall in the margin and revenue both. But I'm talking about from quarter two, what kind of the outlook for the in front in the powertrain business?
I'm not here to look. I cannot really predict about the entire how the pandemic will grow, but it's very clear. It is the need of the hour to modernize the trucks for many of the fleet owners. When they will do it is a question mark, yes. But I think on a very, very low base, we have demonstrated a profitability, and this year will be a better year than last year.
And sir, in powertrain business, you book your revenue for only from machining part, as other players are also ramping up machining capacity and having a strong backward integration. So how do you see revenue and the margin visibility in this business? Are you also looking for some backward integration kind of things in the powertrain?
No, we are not doing any backward integration because our capacities on the machining are very, very high, and it doesn't make any sense for trying any backward integration. And wherever we are doing business with the customer, it is there is a technological superiority, there is quality requirement, but there is also customer sort of stickiness which is there because of the product. I don't see any big threat coming from the higher end of the machining business in the.
And sir, powertrain business, what's your capacity utilization right now?
We were around 75-80% in the region for Q4, and I think that will give some indication to you.
So that means that there's a requirement of the capex going ahead. So what's your capacity addition plan for this segment?
No, we are not planning for any major capacity addition here. I think there may be debottlenecking, for example, tweaking some lines by 5%, 10% if those models or that customer is doing better. And we may be also reducing some capacity with certain customer lines when they are not doing better. So we have the ability to move capacities across. This is very important when compared to the forward integration of the some of our competitors who are doing. They cannot tweak it. So we have got plants across the country, and this is a unique advantage what we have.
Thanks, sir. I come in the queue again.
Thank you. The next question is from the line of Manish Ostwal from Nirmal Bang. Please go ahead.
Yes, sir. Thank you for the opportunity. I have one question on the production realignment from our customer side. Do you see, how do you see the impact of our volumes in the near term?
The customer realignment is taking place on a continuous basis. Sometimes we move capital equipment across the country, even sometimes quarter on quarter to meet such demands or to look at phase in, phase out of some models. We do all that on a continuous basis. On commercial vehicles, it is more or less steady because the number of players are lesser, but on the farm equipment, it is our exposure is lesser, far lesser, and we are catering to almost everybody there. So we are managing this, tweaking this capacity, I would say. So I don't see any change for us going forward. We have been doing this for many years now.
And just to confirm, you said on the call that we'll be reducing our debt 200 crores in FY22. That's right, sir?
Yes, sir. We have reduced debt in FY21 by 200 crore, and we are confident about reducing debt of 200 crore going forward in FY22. From our internal resources, we have reduced debt by 340 crore last year. Out of that, 200 crore was from internal accruals, and capex for last year was 106 crore. So this year also we are confident about reducing debt of 200 crore.
Right, sir. Thank you very much, sir. Thank you.
Thank you. The next question is from the line of Joseph George from IIFL. Please go ahead.
Thank you, sir. Thank you for the opportunity and good set of numbers. Congratulations for that. I have three questions. The first question that I have is in relation to the proportion of machining revenues. So in the powertrain segment, you book revenues sometimes on, or no part of the revenues are booked on cross basis, that is including COGS, that is including material cost, and some part of the revenues are booked on machining charges basis. Would it be possible for you to break down 4Q and 3Q powertrain revenues into machining revenues, as in machining charges revenues, and normally gross of block, gross of.
Yes, we'll break it down, and I'll take your second question first. Then, meantime, I will answer the numbers. Can you make?
We lost his line, sir. So Shall we move to the next question till he joins back?
Okay.
Thank you. The next question is from the line of Chetan Jindoria from Alpha Accurate Advisors. Please go ahead.
Hello, sir. Thank you for the opportunity. Sir, I wanted to ask, what is our average content per commercial vehicle or per MHCV? Or if you can share what is our market share in the CV powertrain. Second question is, are we expecting any major content addition or customer addition in FY22?
We are not expecting any major customer addition in the powertrain. Yes, there are 2 or 3 customers, but I think that will not be substantial by 20-30%. It may be double digit, yes, surely, but not significant enough. We are more banking on from a very low base the market to come back soon. The model-wise, I think it will be different. Whatever we contribute, the heavy-duty segments we contribute more to the product and less on the medium duty. So that far it's also reflected in our revenues. The products are many, so I don't want to get into specific of the parts.
Okay. So broadly, our growth should mirror the industry volume growth, is what you are saying?
We have up to 2-digit growth from new customers, which are not in this geography. Yes. But apart from that, we will be banking on more new products from the existing customers, where our share of the business may be 100% and more value per product, number 1. Number 2, the market coming back, improving from this low base.
Okay. And what exactly is the reason for the low margin in aluminium product business? So even historically, the segment ROC for aluminium product business is low. So is there some kind of turnaround that we are waiting for in this business, or how do you see this segment going ahead?
This is relatively a younger business, and we've been ramping up capacity there. And unfortunately, I think this slowdown in the industry, plus also the higher raw material prices, that the pass-through on the raw material prices are not done instantly. It is on a trailing quarter. So that we had quarter on quarter for the last 4 quarters, we had an unprecedented total 50% price increase. So this is the reason for the lower performance on the EBIT as well as the ROC.
Okay. So what is on a medium term basis, how do you see this segment margin going to 10-15%? Will it take more than 5-7 years kind of thing, or do you think we'll be able to turn this around sooner?
Now this year, I think the aluminum prices will not again increase by 50%. We don't expect that year on year will have increase of 50% year on year. So with this stability and better capacity utilization, the EBIT margins will improve.
Okay. And lastly, I wanted to ask, what kind of customers do we cater to in the industrial and engineering segment, and what is your outlook on that segment?
So the industrial segment, we are well diversified. The major portion is coming from high-end products and sub-assemblies for contract manufacturing for our customers, mainly overseas. This we have been doing for more than 3 decades now. Close to 3 decades now. Apart from that, we have the electrical castings for the transmission industry. We have also the storage business, which is now fast-growing segment in the logistics area. So we feel that this segment will, when the CapEx cycle comes back to India, it will grow very fast.
Exactly, what is the contribution of the storage segment out of the total industrial segment?
The total industrial segment, and you want to know what is the storage segment on sales?
Right. Yes.
Last year we did 104 crore, which I had mentioned in my opening statement, and the industrial engineering segment was around 400 crore totally, which is 25% of the segment now.
Okay. Thank you, sir. Thank you for the detailed answer.
Thank you.
Thank you. The next question is from the line of Akshay Bhor from Premji Invest. Please go ahead.
Hi, sir. Hope everyone is doing well at Craftsman.
I'm sorry to interrupt you, Mr. Bhor. We cannot hear you very clearly, sir.
Am I audible now?
You are audible, but you're not very clear. Can you please come on the handset mode if in case you are on speaker?
I'm not on speaker. Am I audible now?
You may go ahead. If in case it gets worse, we will tell you.
Okay. So my first question is on the aluminum business side. So given the opportunity on lightweighting and even on the EV side, so what is your expectation, let's say 3 to 5 years, how large can this aluminum business be for you? And what are you doing to achieve that? What are the steps to do it?
The line is not clear. You said how large is this segment was one question I understood.
Sir, I'll repeat my question if you don't mind.
I'm sorry,
Hello.
Mr. Moore, but I would request you to please check your phone line and join the queue again because we cannot hear you very clearly.
No, I think I'll answer. I can guess the question, but I'll try to answer. The aluminum content per vehicle on the passenger vehicle is set to increase, whether it is going to be EV or whether it is going to be IC engine on the passenger vehicles, plus also on the two-wheelers, whether it is EV or IC engines, the aluminum content is here to stay. So we will see more aluminum content for better efficiency of these vehicles going forward. Today, India is the beginning of the cycle to improve go on the lightweighting mode. And one more thing, the heavier passenger vehicles will need to be complying with the CAFE norms, corporate average fuel efficiency. I think everybody is looking at reduce the vehicle weight, and every successful new platform coming out is having a reduced weight. This means more lightweighting is happening. So this segment is here to grow. This segment is still nascent in the country. The capacities are more centered around the two-wheeler market. I think it will start moving towards the passenger vehicle market also.
Thank you. I would request Mr. Moore to please check your phone line and rejoin the queue. Thank you. The next question is from the line of Viral Shah from Enam Holdings. Please go ahead.
Yes, thank you for the opportunity, sir, and congratulations on a good set of numbers. So firstly, sir, just want to get your sense on the demand side and how the current environment is looking like in all the three lines of business.
You're talking about all the three segments or in any specifically any segment?
Sir, all the three segments if you could share.
The powertrain business, we are coming from a very, very low base. And that is to our advantage. And post the pandemic, I think there will be a lot of demand for the manufacturing at least, because we know that the models have become more, the powertrains have become more modern. And today we are present in most of the segments of with our customers wherever we are in. And when there is a slight improvement in demand when compared to last year, I think there will be quite a big surge for us for the manufacturing to fill in the pipeline. On the two-wheeler business, the auto aluminum, we are more predominantly present. We are also present on the passenger vehicles as well as the commercial vehicles. We see that one good sign is a lot of exports are happening from the two-wheeler manufacturers, the leading two-wheeler manufacturers in the country, and this is a welcome sign. So this will help to stabilize the two-wheeler business in the country. And post the pandemic, we feel that there will be demand. On the industrial segment, the CapEx cycle, it remains, I'm not an expert on this, but I would say that the CapEx cycle has been subdued for a very, very long time, and there have not been much capacities which have been put on the manufacturing side. And we have been very strong on the manufacturing for 2 decades, mainly and predominantly on exports. And when the CapEx cycle comes back to India, we will be in a position to leverage our presence there.
Sure. And sir, just your thoughts on the current environment. How are you seeing in your interaction with OEMs? What are you kind of sensing? Is there current more? How long will this downturn remain?
Are you talking about the current?
Yes, the current environment.
Market or for?
So for the powertrain and the auto aluminum business.
The powertrain business, anyway, the commercial vehicles, as I mentioned earlier, the base is very, very low. Definitely the modernization is to happen, and there will be replacement market also sitting in. And the modernization from medium tonnage to high tonnage is not complete yet in the country. So when we see demand coming in, we will see the modernization to happen. So on the farm sector, I think we had a very good year last year. There will be maybe some minor correction, but I think this is a very strong segment, and India is also going to be one of the leaders in the lower horsepower tractors for the entire world. So this is also a good sign. A lot of exports are also happening. So that will stabilize. On construction equipment, once the infrastructure spending happens, on the powertrain, we'll be also set to gain on that.
Sure. And just so one last question from my side. I think in part you did allude to the fact that the auto aluminum business suffered this year because of sharp rise in aluminum prices. But if I have to take a 2 or 3 year, probably longer term view, so what is our strategy to turn around this business, and what is the potential opportunity here?
The potential opportunity is lightweighting of the vehicles plus more aluminum content per vehicle. Second will be more new products coming into the market at new pricing. The third thing will be for Craftsman as a whole, the capacity utilization, operating leverage. These are the three things which will fall into place, because we also invested for high tonnage presses, which once it gets going, I think we will be much more profitable.
And sir, what is the potential peak revenue from our current capacities in this business?
I think that it can double.
Okay, great. Thank you so much.
Thank you. The next question is from the line of Nishit Jalan from Axis Capital. Please go ahead.
Yeah, hi sir. Sir, I have two questions. Firstly, on the powertrain segment, if you can share some numbers on the machining mix, which was this year, and also if possible in Q3 and Q4 as well.
Yes, the machining mix for the auto powertrain for Q3 and Q4 plus the segment breakup. Just give me a few more seconds.
Sure, sir, sure.
For the we need the breakup for the machining separately and sales separately. Only machining? Okay. Q3 is 121 crores. Q3 is 121. Q4 is 141. Q3 is 121 crore and Q4 is 140 crore on the machining portion alone. And on the apart from that, we have the sales. The sales is 112 crore on Q3. That is with material, and for Q4 is 105 crore.
Okay, so basically this is the sale to one customer where you book both casting and machining revenues, right?
Yes.
Okay, and sir, full year machining revenues, you said 121 crores for Q3 and 140 crores for Q4. What would it be for the full year?
374. 374.
So sir, higher machining mix in powertrain segment would also have helped our margins on a sequential basis, right?
Any better operating leverage will improve, because we get our margins on the machining value, whether we do it here on the top line may be different, because it is more linked to commodity price. I mean, whatever we buy. I think the more capacity utilization in the plant will lead to better margins.
Correct. Sir, my second and last question is on the aluminium segment. An extension of the question asked by previous participant. You did mention that we are at the start of the cycle where aluminium content, a lightweighting focus will increase significantly in passenger vehicles. So sir, currently this segment is dominated more by two-wheeler OEMs. So are we looking at, or have we got some orders on the passenger vehicle side as well? And what are your thoughts on the commercial vehicle segment? Have we started to see some usage or increase in aluminium content on the commercial vehicle side as well?
On the heavy-duty commercial vehicles, there are only few parts in aluminum. We don't see much change in the philosophy there. On the passenger vehicles, we have got for the powertrain, the conventional powertrain, we got some orders for both from multinational companies for both domestic and export requirements. is yet to start. I think FY23 will be start of production for that. We just got orders recently. So with the passenger vehicles by itself, I think the engines and all other products will become smaller and smaller. The platforms will become more compact or more lightweighted. So we are yet to see that move because the pandemic has slowed down many of the developments which are happening in that field for new models coming in. We have to wait for that.
Okay. So essentially, in the aluminum segment, over the next 2, 3, 4 years, our mix will shift more towards passenger vehicle and CVs compared to the higher dependence on two-wheelers that we have today.
Yes, we already have got a big order for passenger vehicles, which is start of production is 23. Of course, 22 will be the PPAP and other things. So with that, I think that will change, that segment will change.
Okay, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Abhishek Jain from Dollar Capital. Please go ahead.
Sir, your margin in aluminum product business is much lower than peers, while in the other segment like in powertrain business, it is much higher than your peers. Still to understand, is there any intersegmental revenue between both?
No, there is no intersegmental revenue between both. Both are very, very clearly marked. One is fully integrated plant. The point is on the aluminum business, we are making the casting, we are making the machining. So it is fully integrated, and it is totally different. We have got very clear distinctions on there. So material content may be around 50 or more than 50% on the sale value, and when we have an impact of 10-15% quarter on quarter for the aluminum content, that almost wipes out the bulk of the portion of the EBITDA.
Okay, sir. And sir, my last question is related with the revenue mix. In terms of the replacement and OEMs, how is the mix?
You said replacement?
Yeah. How much contribution from the replacement market in overall revenue?
I would put it in a different way because I will just put it in a broad number. Currently, two-wheeler market is more mature. As I understand, 65% is going for replacement. More than 65% of the current sales itself are going for replacement because the life cycle of the product also is not very large. The user age group and the migration towards different models or different vehicles or even four-wheelers are happening. So it is quite mature on the two-wheeler. On the passenger vehicle, I think the replacement market has not fully set in because of the longer life cycle of the product, and bulk of it is still first-time user. The resale, it's not as like the mature markets. That's all I know. On the commercial vehicle, maximum we can go for 1 million kilometers very efficiently for the trucks to operate. Beyond that, they may need to move towards lesser haulage and shorter distances. That is how we are. Historically, we've been operating. So it depends on the usage, the replacement cycle.
So overall replacement is around nil in overall revenue.
No, replacement, I will not like to get into this discussion in detail because it is for the OEMs to give these details. But I think the replacement cycle for the heavy duty has not set in because heavy duty, the sales have started only recently in the last 3-4 years. So that replacement cycle has not set in yet.
Okay, sir. And how is the mix for the domestic versus export in FY21?
The direct export has been very close to 10%, and the Tier 2 export, which is deemed export, is another 10%.
Okay. Thanks, sir. That's all from my side.
Thank you. The next question is from the line of Gaurav Khandelwal from Mirae Asset. Please go ahead.
Thank you, Mr. Ravi, for the opportunity. I hope you and your team members are keeping safe. Sir, just few questions from my side. You indicated that in the aluminum products division and industrial product division, there was some impact of lagged pass-through of aluminum prices. So can you just let us know the steady state EBITDA margin of these two verticals?
We have demonstrated in the past 12% EBITDA with a lesser capacity utilization on a steady state of aluminum content. With a higher capacity utilization, that EBITDA will go up beyond 12% and maybe very close to 20%, I would say, going forward, but it depends on the operating leverage.
So at, let's say, 80% capacity utilization, in both these segments, you can do 20% EBITDA margin, right?
Will be around 18% EBITDA margin on the auto aluminum business.
Understood. And similarly,
12% at a lower capacity utilization without the commodity impact. With the commodity impact, we have come down, but without the commodity impact, we have in the past itself shown a 12% EBITDA margin.
Okay. And so in the industrial product division, what will be our capacity utilization? You have indicated about the aluminum, both the aluminum segments, but in the industrial side?
In the industrial segment, I think in the last year we have utilization has been less than 50%.
Less than 50%. Okay, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Akshay Ghor from Premji Invest. Please go ahead.
Sir, am I audible this time?
Yes.
Okay. So just on continuing on the aluminum business side, given currently at 110 crores of quarterly run rate, so assuming that you're working on some of the contracts which will materialize in FY23, what kind of run rate revenue should we assume, on an annual basis in, let's say, FY23 post some of these contracts?
We are talking about FY23, right?
Right, sir. Right.
FY23, I think the run rate will be minimum double.
Minimum double as in you're saying 220 crore kind of run rate or what?
Yes, sir. Yeah, double.
Understood, sir. Understood. Okay. Sorry, just to clarify, you're talking about a 800 crore kind of run rate, or you're saying annual?
Of course, it depends on the product mix. Sometimes the weight of the part may be lesser, but the value addition may be higher. So I would rather say that we'll be upward of 650 crore for FY23.
Got it, sir. Got it. And this should come in at whatever 18% kind of margin that you.
Yes, correct.
Perfect, sir. Perfect. So just, trying to understand the near-term numbers a little better. Q1, whatever run rate you're doing in April and May, would you be, let's say, similar to what you did in Q3 of about 490-500 crores, or should we kind of expect some moderation in revenue trajectory?
I would answer the question a different way because we will not know how Q1 is behaving, Q2 is behaving. It depends on government, it depends on the pandemic, it depends on the OEM's policies and things like that. But the inherent latent demand is still available. When it bounces back, we will not know. And we are still at a very low base last year, and we have demonstrated close to 100 crore PAT on that, and with the EBITDA of 440 crore. We are very confident that last year we reduced it by 200 crore from our internal resources, apart from the 130 crore. So with no more capital infusion, we are very confident about continuing with the CapEx cycle of around 100 crore approximately with the capacity balancing and maintenance CapEx, and still going ahead and reducing the debt by 200 crore in the current year. That means the cash flow situation has to be very strong, and our EBITDA and EBIT margin has to be strong to demonstrate that. So I will not like to get into Q1, Q2 numbers because it's not within our control as of now.
Got it, sir. Got it. No problem. And just a couple of bookkeeping questions. In terms of interest expense for next year, what kind of numbers work with? Is a 7% kind of interest rate on this, let's say, worst case 700 crores is something that we should work with? Or?
I think last year itself, our overall financial cost itself was around, actual financial cost was around 80 crores, 80 or 85 crores. Balance was lease rental, like building rental and things like that, including some equipment rental, all put together was classified under Ind AS as depreciation and financial cost. That was amounting to close to 20 crore. It's a broad line number. So this 80 crore actual financial cost for FY21 will come down by further at least 25 crore in this particular year. So the sum up of the financial cost, as you see in the P&L, may be around 80, including the lease.
Yeah. Understood, sir. And sir, the depreciation expense for the next 2 years, what kind of run rate should we assume?
We have peaked on the depreciation. You might have noticed that depreciation is hovering around 200 crore. This is the peak. We have done the extrapolation. Some things are going out of the period of service, so it is getting obsolete. So all put together, I think with the lower capex which we are doing now, and normally the capex is equal to the depreciation to sustain. That is what is called maintenance capex. But we have succeeded in extending the capital life, and we are doing a lower capex in the last 2 years. So, and also in this year also. So depreciation will not increase further than whatever is. It will be hovering around the 200 plus, 208, 210 crore range is what we see.
Just thanks. I'll leave it at that, sir.
Thank you.
MAT credit is still available. We'll be still under the same tax structure. Last year we were under MAT. This year also we'll continue to be under MAT. MAT utilization, we had utilized around 20 odd crore last year. Still we have around 26 crore what we utilized last year. Around 68 crore is still available for us.
Thank you. The next question is from the line of Kirti Doshi from Antique Stock Broking. Please go ahead.
Yeah. First of all, congratulations, sir, for your listing in the capital market. And I'm sure the listing is not only the criteria which you must be looking. You must be looking at the shareholders creating value also. I have a different question than whatever my other all colleagues has asked. So most of the questions they ask on the business side, and I'm sure that you have given them the confidence and you will do well. I want to know 3-4 things. What was the total fees paid for this issue to the investor banker and to all other agencies? I want to know that despite the best of the time in the IPO market and best of the time after the listing, why our stock is still trading lower than the value where the IPO is offered? And despite the best of the investor come onto the IPO in the investment list. Plus, I wanted to know whether the issue was overvalued by the investor banker or they have been sold by them. The issue response was also very, very low. And after that also, the work of the issue is over, the listing has happened. Whether any handholding of those people earlier are still on, and whether the shareholders creating value is the agenda of the management or not. And for that, what are you all going to do?
Thank you for this deep and probing question. What is within my, I would say, field of answering, I will answer. I am a first-generation entrepreneur. Private equity has entered the company in 2010. We worked diligently hard. Yes, we have grown the company almost to 10x in the period of this 10 years period of the private equity investors. You might have noticed, unlike many other companies, the primary fundraise has been very low. Very, very clearly, we see as management of the company and as also a key shareholder, a lot of value in the company going forward. And we are not aligned to any business family. I am coming from a family of doctors. We see that the business is standing on its own feet. I see that whoever is invested in the company, they see value over a longer period of time. It's not for the short term. It is a short term means there can be ups and downs, and there's no handholding anywhere. I would say that it's going on merit on its own steam. Beyond that, I'm not entitled to answer. And coming back to the IPO expenses, we have done our best, whatever we can do to control the IPO expenses. You would have seen that we are not splashed any big advertisements anywhere, and this will be on public domain on the expenses, which you can always get it from the domain, which is available for all shareholders.
So why can't you officially say also? If a public domain, then it must be under your knowledge also. So better to specify.
It's not yet over because IPO expenses are still there to complete, so we cannot explicitly say at this particular point of time.
The prospectus. It's a simple question. It's not a complicated question, sir.
As CFO answered, still the invoices are coming in for the retail and all. Once it is settled, it will be approved by the board and it will come on public domain. Surely you will be able to see it.
Thank you. I would request Mr. Doshi to rejoin the queue. The next question is from the line of Rajesh Kothari from Alpha Accurate Advisors. Please go ahead.
Thank you, sir, for providing an opportunity. I have only two questions. The first question is, if I look at asset turn of your company, it has been always below 1, roughly hovering between 0.75 to 0.9, and probably in the current year roughly 0.95. So my first question is, how do you see the asset turn of the company? Can it increase beyond 1, or because of the kind of a business in which you are, probably it will remain around 1? That's my first question. And my second question is, if I look at the return on net worth of the company, generally it has been very, very low single digit kind of thing, except probably 1 year. So how do you see ROE trajectory over next 2-3 years?
Coming to the asset turn, the business model about the machining charges and the with material sales will be always lower than our peers because of our business model. But surely the capacity utilization, as you would have seen, we have done 535 crore in Q4. I mean the exact number, approximately. So you know that on that we calculate that and multiply it by 4, asset turns will be better. And we have also told that the capacity utilization has been around 75% for Q4. So with that, there is a margin, there's more headroom to go higher. And coming back to ROC, I think we have demonstrated that in the last year 16% ROC.
No, I'm talking about ROE first of all.
ROE is 11% for 21.
Yeah, that's what I'm saying. So ROE is basically very low, am I right? And if you look at last 6 years also, except probably FY19, your ROE was below 10%. So my question is, how do you see the ROE trajectory over next 2-3 years? And since on the first question you said that the business model, pardon for my ignorance, but I am attending this call for the first time and I have not, met you pre-IPO. So can you please explain what is that business model and therefore why it is always below 1 time?
You could see that the EBITDA is much, much higher than the peers. That means our value addition to the sales, the percentage of value addition is much higher. That is, the material content in our top line sales is lower. That is because of that, you see the top line which is looking depressed. But the value addition, when you take the gross margin and compare, then you will find that we are in line with the peer group. Second point on ROE. ROE last year was not a good year from the pandemic. We have demonstrated 11%. Yes. In the previous year, it was BS6. That was 1 year of operation, for the entire auto industry. Year before that, we have demonstrated good ROE.
Okay, so basically you are saying because of the value addition is high and therefore that leads to probably lesser asset turn but higher profitability. But when you do the contracts with the customers, do you follow kind of a cost plus things, or do you follow ROC based pricing, and in whichever method you are doing it, what are the typical benchmarks what you follow?
Surely it will be ROCE. At the same time, sustainability of the business we have to see. We have to see the longevity of the business. We have to see also the risk which is involved in the business. These 3 other factors along with ROCE will be factored.
And therefore, what is your benchmark ROCE?
We are the minimum ROCE we are looking at is around 16%, which that's what we are looking at.
Okay, and this is basically what ROCE is like PBIT upon average capital employed?
Yes.
Okay, fine. Last question from my side. This aluminium business, the price hike, do you think it is like 1 quarter lag? So in first quarter you will get the price increase, or it is normally beyond 1 quarter?
No, the trailing quarter we will get the price correct. Trailing commodity price trailing quarter's commodity price will be the price for the next quarter.
Oh, I see. So every quarter, basically last 3 months trailing, that's how it works.
Yeah, that's unfortunately we had 50%, close to 48% increase in one financial year.
Yes, that's fine. So probably, so that you will get in the first quarter, am I right? Whatever is the increase, whether it's 40% or 5%, I mean, whatever the increase, you get it, am I right?
We got the 10% quarter on quarter, but every quarter again it was increasing. We are buying at a new price and we got corrected for the last quarter. So it has to be more stable. Now it is getting stabler. Hopefully it will remain.
Okay. Thank you, sir.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Srinivasan Ravi for closing comments.
Thank you very much for joining this first investor call, earnings call. In spite of the pandemic and your other commitments, thank you for taking the time and attending. And I also gained a lot of insight how we look at the results of the company, and we will continue to get these inputs from you. We'll continue to take these inputs in our business planning and try to handle the company going forward in a better way. Yes, we are in some challenging times that has to be recognized by everybody. It is beyond our control, and we look forward for the next earnings call.
Thank you. On behalf of Craftsman Automation Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.